In this episode, we're going to talk about whether you should flee the stock market or weather the storm. But before we do, a quick disclaimer from compliance. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation. Securities and investment advisory services offered through Osaic Wealth Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth. That was a mouthful, but we are now compliant. So now let's get to the episode.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello, my name is Brenton Harrison of New Money, New Problems, and your host for the New Money, New Problems podcast. It's a crazy week. We're going to talk about some of the craziness in just a second and the goal for this episode. But before we do, some additional closeout from our series on pivoting into entrepreneurship. Hopefully you went to newmoneynewproblems.com/pivot and downloaded the full unedited episode that we did where we did interviews with the various entrepreneurs in our circle who left thriving careers to start their journey of entrepreneurship. Highly encourage you, if you haven't, to go back to that site and get that unreleased episode, or to simply join our email list at newmoneynewproblems.com/subscribe. The reason being is that we are actually going to release a private podcast episode just for our email audience where we interviewed Rachel Moore Beard. Rachel is a good friend of mine. She's also a career coach who walks people through the process of assessing their current job and if they are considering the leap into things like entrepreneurship, shepherding them through that journey. So we had a great interview where we talked about, the questions people should ask themselves, the different things they should be looking for in terms of a fulfilled life when it comes to the relationship between life and work. So if you go to newmoneynewproblems.com/pivot, you can download last week's episode, the unedited version, plus you'll be on the list to get the private episode we do with Rachel. Or if you're on our general email list already, we're going to release that to everyone in our community. So I encourage you to subscribe. Now, on to this week's episode. I will tell you that there are a lot of people who are calling me, clients, friends, family, asking, is the world coming to an end? Should I pull all the money out of the market? What should I do? Should I run for the hills? And I identify with all those concerns. It's hard for me to stop watching the news. Although my goal is to give you some encouragement in this episode to at least, add some perspective as to why watching the news isn't necessarily instructive or informative when it comes to your finances. So my goals for this episode are these. I want to hopefully give you some context into, hey, this is not the first time that we've had major events in this country. So even though past performance is not indicative of future returns, we can at least go back to those periods, see how the market performed, and hopefully give you some comfort that it is not all doom and gloom, even when the rest of the world is doom and gloom. And my second goal for this podcast is to give you some investment behaviors after the break that you can use during periods of market volatility to position yourself to come out on the other end of it as good as possible. And now that I've given you those disclaimers, let's actually get into the meat and potatoes of the episode, starting with this. I guarantee you that if you believe that the sky is falling, and it may actually be falling, that it is going to fall whether you keep your eye on it or not. So there's a certain level of hope in my voice that after this episode, you will just keep on doing some of the things I tell you to do in the second half and just stop looking at your investment account balances every day. It is not helpful. And what it leads to in most cases is you making an action that is counterintuitive to what would actually benefit your finances. The reason I say it could be counterintuitive is because in periods like this, where there's severe amounts of volatility, we often have the assumption that the stock market is going to perform terribly over the course of the next several years, when in reality, at least if past is prologue, that has rarely been the case. Let me try to show you some historical precedent. If you're looking on screen, you're looking at a chart of the S&P 500's returns going back like 99 years to 1926. As a recap, we've talked about the S&P 500 on this podcast before. They are the 500 most cash-rich companies on the U.S. stock exchange. So this is something where people have seen it as the gold standard of investing over a long period, because since it's the 500 most cash rich, if for some reason a company is doing poorly and is no longer a part of that 500, they are replaced by a company that has taken up their place in the ranks. So it's almost like the law of natural selection. The cream rises to the top, which is why people typically follow this index when they're trying to see how the market is doing. So let's go back through some of the worst periods in our country's history over that period of time. We're going to start with World War II. World War II was 1939 to 1945. I'm going to be talking about U.S. involvement in these wars since it's an American index. So if we go to 1939, we can see that for the first 3 years, the market was down, negative 0.41%, negative 9.78%, negative 11.59%. But from then on, 20.34, 25.9, 19.75, 36.44, and over the course of the years of World War II, the S&P 500 actually averaged just under 12% through that stretch of time. Let's go to the Vietnam War. Vietnam War is from 1965 to 1973, and you will see that over the Vietnam War, even though it was an extended period of time, the S&P 500 averaged just under 6% in terms of an average annual return. Even in the depths of warfare, when we have the assumption that the stock market would do nothing but tank, there is historical precedent to see that we are often incorrect in that assumption. Does that mean that that's what's going to happen this time? No, but at least gives you the opportunity to go back to World War II, Korean War, Vietnam War, post 9/11, 2008, to say, hey, it has happened this way in the past. There is a strong possibility that it could happen this way in the future, and that my desire to run for the hills may be a thing that actually prevents me from having those market gains when the market's on the upswing. If you're not convinced, I want to show you another chart that will hopefully get you off the fence and stop this thought process of, oh, I'm going to take it out now and I'm going to just go back in when things have settled down. Because another thing you need to know about volatility in the market is, historically, some of the best days in market history have been in the midst of periods of intense market volatility. If you're looking on screen, you're looking at a portfolio presentation that was put together by Jackson National. And I'm not going to go through all these numbers, but on the right of this slide, it shows the 30 best days of performance in the S&P 500 since 1994. And what you will find that when they're looking for the 30 best days over the course of the past 30 years, 24 of them came during COVID, the financial crisis, or the tech bubble. What does that mean? It means that if you had tried to take your money out, hoping that you could just put it back in when things got better, you would have missed some of the best days in the market, because often it's not at the end of the process that you see gains. It's when you stick with it through the process and follow certain behaviors that you can recover on the right side of events like what we're seeing now. Now, what does it mean to have the right behaviors during periods like this? We're going to talk about that after the break, but what I'm hoping that you're seeing is, yes, this is a tough time. Yes, this is a volatile time. Yes, it's a scary time. But that does not necessarily mean that you can predict what will go on in the stock market. And as a result of not being able to predict it, I want you to follow the basic investment behaviors that we talk about after the break that I feel will give you the highest chance of benefiting, at least from your investment portfolio. I can't talk about all the other things that are going on in the world, but from an investment perspective, these behaviors will position you for success if only you can stay the course.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
All right, so what are some of the behaviors that can position you for market success during periods of market volatility? Well, the first is to remember the first rule of investing. And the first rule of investing is to buy low and sell high. As simple as that sounds in theory, it is much harder to practice in reality. But all you need to know when following that rule is if you have a desire to pull your money out of the market because it experienced a loss, then you are not following the first rule of investing. In reality, a period like this is the ideal time, assuming you have a long time to invest, to put money into the market. So as tough of a conversation as it is to have when people have been calling me this week and they have a long time to invest, but they're terrified of what's going on, and they ask me what they should be doing, I'm telling them, if you have money in savings, if your consumer debt is low and you can afford to put more money in the market, now is the time to put money in the market because prices are low. There's a more crude saying that we've shared on the podcast in the past, and that is when there's blood in the streets, buy property. It's essentially telling you that when things look the craziest, it is often during those periods that people gain property and put themselves ahead of their peers because they're taking advantage of that fear and using it as an opportunity to buy distressed assets. The next question, however, is how do you put money in the market? And my recommendation would be to do so through what's called dollar cost averaging. This is another concept that we've discussed on the podcast. It's far more complicated in terms of the term than it is what you're actually doing. All dollar cost averaging is putting money in the market in increments. So instead of plopping it all in at once, you are taking a 3-month period or a 6-month period or an every 2 weeks period like your 401k, and you're putting in equal amounts in each of those increments. A lot of us don't have perfect timing when it comes to when we buy a stock. We think we have found some tip that's going to make us all the money in the world. And by the time we actually purchase it, the growth has already been experienced. And because you don't know the timing, what dollar cost averaging hopes to do is to get you the lowest average price per share over an extended period of time. It's supposed to take the guesswork out of trying to time the market. Now, the great thing is if you have a 401k or a 403b, you're already practicing dollar cost averaging without even knowing it. You're doing biweekly payroll contributions to that account. And as long as you keep making those contributions, you're giving yourself a good opportunity during periods when the stock market is low to still have money hitting the market. And outside of your 401k, if you do have money to invest in things like the non-qualified brokerage accounts that we've recommended you open on this podcast, then instead of just saying, oh, I have $500, I'm going to put it in right now, and then not putting money in for the next 6 months, take that $500 and say, I'm going to do $100 a month for the next 5 months, and let's see what happens over an extended period of time. But over the long run, at least historically, using tools like dollar cost averaging and consistent incremental contributions has led to a lot of success when it comes to investing over the long term. Now, while we're on the topic of 401ks, we need to talk about some of the things that you need to keep in mind with old 401ks. It's very common for me to meet with a young couple or a young person, and they are at a great job. And when you look at their finances, they have 2 or 3 or 4 old 401ks at previous employers that they haven't done anything with. To me, that is very dangerous in times like these. And it's because of a little exercise, or I should say it's illustrated by an exercise that I walk through with people very frequently when I'm trying to show them the danger of having an old account out there to which they're no longer contributing. I think we've done this on the podcast in the past, but if we have, just bear with me. If I give you $1 and I put that dollar in the market, and in the first year, the dollar loses half of its value. And at the end of the year, you have 50 cents left. You started at the dollar, lost half its value, you have 50 cents. Now, if the next year you regain half of your value, a lot of people would say, oh, you're back to $1. It went down 50% the first year, up 50% the following year, so you're back at $1. But you're not. You're at 75 cents. Your dollar went to 50 cents. And regaining half of 50 cents would put you up to 75 cents. So it's the same numerical return, negative the first year, positive the next, but you would only get back to your dollar if when your investment lost money, you put money in when the market was low. Now, that's what we're talking about with dollar cost averaging, putting in those consistent contributions. But with an old 401k, you cannot contribute to a 401k at a job where you no longer work. So in these instances, having those boilerplate accounts where you have these just very basic investments in a 401k, and then you leave it out there not contributing to it, when you have market losses, it becomes infinitely harder to recover from those losses in those dormant accounts. So my recommendation, if you have those old 401ks, is to do one of two things. The first option is to roll it into the 401k or the 403b at your current employer. And by having those funds consolidated, you are giving yourself the ability to benefit from dollar cost averaging in a consolidated account. So when the market is low, you are buying low with all of your money, as opposed to just buying low with the money in your current 401k and leaving those old accounts out there to starve. That's the first option. The second option is you can roll those funds into a rollover IRA. And to me, depends on the client. There are some times when I recommend they go into their current 401k. There are other times where it's a significant amount of money that they've set aside in those accounts where I recommend that they put it into a rollover IRA because it's either a lot of money or they're closer to retirement. And instead of chasing returns or being limited by some of the more basic investments that they have in that company plan, rolling it into an IRA gives you more flexibility in terms of the investments that can go inside of that account, or even whether you choose to have that account managed. And in talking about investment allocations, I do want to acknowledge that when I say to like just stop looking at the sky, even if it's falling, I'm not being literal. I understand that that's like very difficult to do in reality, where it's like the stock market's tanking. You're asking me to just not look at the news, not look at my investment accounts. And that's very hard to do. It's almost like telling a celebrity, who gets sensitive when somebody says something about them, well, stop reading the comments. Well, in reality, if there were 1,000 people talking about you on a social media platform, you'd probably want to log on and see what they said. So it's very difficult to do. However, I do think something that can give you some comfort in terms of how your investments get you through these times, especially if you can't turn off the television or stop looking at your phone, is by having an assessment of your risk tolerance and making sure that the investments that you're currently invested in reflect that risk tolerance. An example of risk tolerance is you could be a conservative investor, a moderately conservative investor, a moderate investor, a moderately aggressive investor, an aggressive investor. It's just an assessment of how much risk you can stomach. A common question when determining someone's risk tolerance is, if your investment lost 10% over the course of 30 days, how would you respond? And based on that person's answer, it kind of gives you an idea of what their risk tolerance might be. Now, the lower your risk tolerance, the lower your appetite for seeing the big swings in your portfolio. And that's okay, as long as you have an understanding of that being your personality and can take that information and knowledge into evaluating how you're currently invested. If you are someone who just cannot stomach when your account loses $50 and then you go into your account and you find out that 90% of your portfolio is in stocks and 10% of it is in bonds, you might be in for a rough period of time when it comes to market volatility and your ability to stomach that risk. And while there is a middle ground where you don't want to be invested in the most conservative things just because you don't like losing money, there is also the other extreme that says, hey, my investments are just not in alignment at all with what makes me comfortable. And if I need to dial it back in terms of their aggression over the next few years to give me an increased level of comfort, then that may be a step that I need to take. So what we're going to do to help in giving you that perspective is we're going to put a risk tolerance questionnaire in the show notes of this episode. So you can just take the quiz for yourself and see what type of investor are you in terms of your comfort level. So those are all the lessons that I have for you today. Some of those lessons may be a little insulting, like when I told you that you don't know how to time the market. I don't know how to do it. You don't know how to do it. So stop thinking that you know exactly when the market has reached its low point and you'll know exactly when it's time to put money back in. That's not the case. Another lesson is just because things are volatile doesn't necessarily mean that we're heading for poor market returns. We may be heading for a lot of calamity and trouble when it comes to general society. But if past is prologue, there are periods where we've been in similar situations as a country and the performance of the stock market has still been positive or not as negative as you would have thought when you look back at how it performed over a series of years. And then finally, follow basic investment behaviors. Do not buy high and sell low. Continue to put money in the market on a consistent basis. Make sure that you've consolidated old accounts so they're not left out there to starve. And make sure that the investments that you do have are aligned with your level of risk tolerance as an investor. Our goal is to provide as much comfort and knowledge as we can in times like these, especially when people are concerned about their finances. So we may go a little more investment heavy over the next few weeks and even find some special guests who may be able to come in and share some even more in-depth investment knowledge than I'm able to provide. So look forward to that over the coming weeks. Feel free to reach out to us with episode recommendations or people that you want to hear from, and we'll do our best to follow that request. And I'll see you again right back here next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.